Markets can recover faster than people can update their emotions. That is one of the hardest lessons in investing. A person looks at the news and sees war risk, oil risk, inflation risk, interest rate risk, political uncertainty, and a world that does not look stable. Then the same person opens a chart and sees the S&P 500, the Nasdaq, and Bitcoin moving almost as if the danger disappeared. That contradiction creates confusion. It feels irrational, and in many ways, it is irrational. But markets are not designed to be emotionally fair. They are designed to discount probabilities, liquidity, positioning, earnings, and human behavior. Sometimes they move before the real world feels better. Sometimes they move because the worst-case scenario did not happen. Sometimes they move because investors were positioned too defensively. Sometimes they move because people who waited for clarity suddenly feel they are being left behind. That is what we are seeing now. Over the last 30 days, the S&P 500 and Nasdaq have staged a strong V-shaped recovery. Bitcoin has also moved sharply, rising from around $66,000 to near $80,000 at the time the source was recorded. On the surface, that looks like confidence returning. But confidence is not the same as resolution. The main trigger appears to be the extension of the United States and Iran's ceasefire. Investors are taking comfort from the fact that the conflict has not immediately spiraled into a larger global shock. In markets, avoiding the worst case can be enough to create a rally. People do not need everything to be fixed. They only need the probabilities to shift away from disaster. That is an important distinction. Markets can rally on relief. Relief is not the same as safety at the same time. Corporate earnings have remained strong enough to support the S&P 500. Companies are still producing profits. Expectations for earnings growth are still being revised upward. And the artificial intelligence story has not slowed down. Updates in AI models, infrastructure spending, and investor enthusiasm continue to support large-cap technology and the broader risk. On mood, this is why every dip in large-cap United States stocks has been bought aggressively. The market sees AI as a productivity engine. It sees earnings resilience. It sees a possible easing of geopolitical risk. It sees a future where capital continues to flow into technology, automation, robotics, and digital infrastructure that creates a powerful upward force. But the upward force does not remove the downside risks. Oil is still elevated because the supply risk around the Strait of Hormuz has not disappeared. A ceasefire is not a permanent settlement. The Iran situation is not fully resolved. Drone attacks, shipping risk, military tension, uranium enrichment, sanctions, and the possibility of miscalculation all remain part of the environment. So the current rally is not an everything is fixed rally, it is a short-term relief rally supported by earnings strength, AI enthusiasm, and the belief that the worst-case scenario has been delayed. That is very different. If you confuse relief with resolution, you may take too much risk at the wrong time. If you confuse unresolved risk with a reason to sit in cash forever, you may miss the upside of one of the largest technological transitions of our lifetime. This is the tension. The market may be irrational in the short term, but it can still move higher for a long time. The macro risks may be real, but waiting for a perfectly safe environment can be a very expensive habit. That is why I think in probabilities and systems, not certainty. There are two truths operating at the same time. First, the market can easily see another correction because oil, inflation, war risk, and Federal Reserve policy remain unresolved. Second, on a higher time frame, productive assets, technology, and the risk assets connected to the next wave of innovation may still be moving into a much larger cycle. The investor who sees only the first truth becomes paralyzed. The investor who sees only the second truth becomes reckless. The better investor respects both. That is where the strategy becomes clear. Do not sit entirely on the sidelines waiting for a perfect crash that may not come. Do not deploy everything at once as if risk has disappeared. Average into the market systematically while keeping cash reserves for a larger dip. This is not glamorous, but it is rational. If you invest recurring amounts every week or every month, you participate if the market keeps rising. If the market falls, your future contributions buy lower prices. If a larger dip appears, your extra cash gives you the ability to act when others are afraid. That is the balance. People often want one answer, all in or all out, buy now or wait, bull market or bear market. But reality is usually not that clean. The right answer in an uncertain environment is often to participate with a system while preserving optionality. That is why dollar cost averaging is so powerful for people in the wealth accumulation phase. Historically, markets spend more time in bull conditions than bear conditions. The S&P 500 has finished positive in roughly 7 out of 10 years. That does not mean the next year must be positive. It means the long-term base rate favors participation, not permanent fear. If you are young, building wealth, earning income and investing over years, the biggest risk may not be short-term volatility. The biggest risk may be sitting out the greatest technological transition of your lifetime. That transition is artificial intelligence, and this is where the story becomes much bigger than a market rally. AI is not just another software cycle. AI has the potential to change labor, productivity, income distribution, business models, government policy, and the structure of opportunity itself. When people like Elon Musk and Sam Altman talk about universal basic income or universal basic wealth, they are not saying this because it sounds entertaining. They are responding to the possibility that AI may displace a large portion of traditional work. The details are uncertain. It could take 5 years, it could take 15 years, it could take 50 years. But if some of the smartest builders in the world are preparing for a future where many people no longer have jobs in the way their parents did, then a serious person should pay attention. You do not need to know the exact timeline to prepare. That is the important principle. If the future is one where AI drives enormous productivity and wealth creation, then there will be two broad groups of people. One group will be consumers inside someone else's economy. They may receive checks, they may receive benefits, they may live on government support, they may rent from people and institutions that own the assets, the infrastructure, and the machines. The other group will own pieces of the systems that produce the abundance. They will own businesses, technology exposure, Bitcoin or other monetary hedges, gold or hard assets, international diversification, growth equities, and other assets tied to the new economy. This is why financial positioning matters. Money does not solve every problem. It does not create meaning by itself. It does not guarantee happiness, but it does create options. It determines the neighborhood you can live in, the schools your children can access, the risks you can absorb, the time you can control, and the degree to which large problems remain manageable. This is why wealth is not just about luxury. It is about agency. And if AI creates a major wealth transfer, the people who own assets before the transfer fully happens may end up on a very different side of history than the people who only consume the products after the owners have already become rich. That is the warning. Not panic preparation. We have seen this type of shift before. During COVID, many people dismissed the early signals. They said the problem was far away. They said it would not affect them. Then suddenly supply chains broke. People were locked inside. Markets crashed, central banks printed, assets recovered, and wealth shifted dramatically toward people who owned risk assets and technology infrastructure. The same emotional pattern can happen with AI. Some people say AI is a bubble. Some people say AI will never be good enough to replace their jobs. Some people believe AI will change everything but still do nothing. Doing nothing is also a decision, and in a world where assets may compound rapidly around a new technological system, doing nothing can be the decision that makes you a consumer instead of an owner. That is why the focus should not be on every headline. The focus should be on what actually moves the needle in this environment. There are 5 needle movers. The first is the war in Iran. The market is reacting to the probability that the conflict either escalates or remains contained. The United States wants to stop Iran from holding highly enriched uranium and continuing enrichment. It wants to reduce Iran's missile capabilities. It wants to keep the Strait of Hormuz open for oil tankers without Iranian limits or tolls. Iran wants the war to end, sanctions lifted, compensation for damage, control, and authority over the Strait of Hormuz, continuation of its enrichment program, and eventually a withdrawal of United States combat forces from the region with broader non-aggression commitments. Those goals are far apart because the goals are far apart. The most likely path may be a messy middle. The blockade remains, tensions flare. Isolated incidents happen around the Strait of Hormuz. Both sides test each other. Negotiations continue in the background. That kind of environment can produce rallies and sell-offs. It can create relief when the worst case is avoided and fear when a new incident appears. That is why investors should not overreact to every headline. They should ask whether the headline changes the probability of a full escalation, ground invasion, Strait of Hormuz closure, or oil supply shock. If it does not change those probabilities meaningfully, it may be noise. The second needle mover is oil. Oil is the fastest transmission mechanism from war into the economy. If oil stays high, inflation can stay high. Margins can come under pressure, consumer spending can weaken, shipping and transportation costs rise, gasoline becomes a tax on households. The Federal Reserve becomes less able to cut rates. For a true broad bull market where all-time highs are reached across risk assets, oil likely needs to cool down. If oil moves higher from here, Liquidity can be sucked out of risk assets because investors begin to expect tighter financial conditions, higher inflation, and a less dovish Fed. Oil is not just a commodity chart, it is a macro signal. The third needle mover is inflation and interest rate cuts. Rate cuts are one of the most direct ways that risk assets accelerate. Lower rates make borrowing easier. They support housing, they support business investment, they reduce discount rates, they can push investors into stocks and crypto because cash yields fall. But rate cuts are not guaranteed. If oil keeps inflation high, the Fed cannot easily ease. Even if leadership changes and Kevin Warsh replaces Jerome Powell, policy still has to deal with inflation, bond yields, the dollar, and the credibility of the central bank. Markets often price rate cuts before they actually happen. If the probability of future cuts rises, markets can rally even before the first cut arrives. That is why investors must watch inflation expectations and rate cut probabilities, not just the actual meeting decision. The fourth needle mover is corporate earnings. Earnings are one of the biggest reasons the market has remained resilient. Companies are still making money. S&P 500 earnings growth expectations have been strong, and upward revisions can support higher equity prices. At the end of the day, stocks are claims on corporate profits. Liquidity and sentiment matter in the short run. But over longer periods, earnings matter a great deal. If earnings continue to grow, markets can absorb a lot of fear. If earnings disappoint, the rally becomes much more fragile. So do not only watch political headlines, watch whether companies are still producing cash flow. The fifth needle mover is AI optimism. The market is still trading on whether investors believe the AI trade is intact. When a low-cost model from China appeared and people believed it threatened United States AI dominance, Nvidia lost hundreds of billions of dollars in market value almost overnight. That shows how sensitive the market is to the AI narrative. If investors believe the AI infrastructure cycle remains strong, large technology companies can keep leading. If investors believe AI spending is slowing, too expensive, or less defensible than expected, the market can sell off quickly. This is why AI optimism is not a side story. It is one of the pillars holding the current market together. When you combine those five variables, the current environment becomes easier to understand. The Iran war looks less dangerous than it did at the worst moment, so markets bounce, earnings still look strong, so stocks remain supported, AI optimism continues, so large cap growth attracts flows, but oil remains high, inflation risk remains, and the Fed is not fully dovish, so another correction remains possible. That is the map. If oil cools back toward levels seen before the war, inflation stays contained and corporate earnings remain strong, the market can grind higher if oil stays elevated. Inflation ramps back up and the Fed cannot ease, then another correction becomes much more likely. This is why I would not react to every Bloomberg headline, every tweet, every alert, or every short-term panic. Most information does not matter. The question is whether the information changes one of the major variables: war, oil, inflation, and rates. Earnings AI, that is how you reduce information overload. The modern investor has too much information, not too little. Years ago, Wall Street had more data than ordinary people. Today, social media, AI tools, public filings, dashboards, on-chain analytics, and research platforms create a fire hose of information. Retail investors can access more data than ever, but more data does not automatically create better decisions. More data without a framework creates paralysis. A person reads everything and does nothing. They watch every video, every chart, every tweet, every report, every rumor, every call, every hot take. They become informed but not positioned. That is not investing, that is consumption. A serious investor filters. A serious investor asks what actually moves the needle. A serious investor builds a watch list before the market becomes obvious. A serious investor knows when to deploy and when to wait. Now the big question is where asymmetric upside exists. Asymmetric upside means the potential reward is much larger than the potential loss, or that the market has not yet fully priced the narrative, liquidity, and attention that may arrive later. These opportunities are not easy. If they were obvious, they would already be priced. The framework is to look for strong narratives before the world fully understands them. Where will attention go? Where will liquidity go? Where is the upside large? Where is the downside limited relative to the potential? Where has the asset shown relative strength during uncertainty? Where is the development happening faster than the market appreciates? Where is the crowd still asleep? This is how large opportunities often form. In the source, the example is Aerodrome. The idea was to recognize the base chain narrative before it became mainstream. Coinbase had a plan to onboard enormous numbers of people and build financial products through Base. Aerodrome was positioned as the decentralized exchange infrastructure for that ecosystem. The narrative was early. The attention had not arrived, liquidity had not fully arrived. The token was still extremely cheap relative to what the thesis could become. That is the anatomy of a high-conviction asymmetric trade: narrative, infrastructure role, liquidity path, exchange accessibility, low attention, large upside. Then comes the hard part: conviction during volatility. After the first purchase, the asset went down. Coinbase had technical problems. The market sold, the position looked wrong immediately, but if the thesis was strong and the price action did not invalidate it, the disciplined investor could add rather than panic. That is how a large gain can happen. But this lesson must be handled carefully. The lesson is not full port every speculative idea. The lesson is that rare asymmetric opportunities require deep research, strong conviction, clear invalidation, and proper sizing relative to the person's financial situation. The source story involved very aggressive concentration that can create massive gains, but it can also destroy capital. A serious investor should separate the principal from the risk level. The principle is to find narrative, liquidity, attention, and relative strength before the crowd. The risk is overconcentration. You must know who you are if you are building wealth from a small base. You may be more willing to take concentrated risk. If you have already built wealth, preservation becomes more important. The source makes this point directly after making multiple seven figures. The goal changes from full accumulation to preservation plus selective upside. That is how risk should evolve. The right strategy at one stage of life may be wrong at another. Now, relative strength matters. When something refuses to fully die during fear, pay attention. If the market is weak, crypto is weak, liquidity is thin, and yet a specific asset holds up better than expected, that is information. It tells you buyers may be present. It tells you the narrative may be stronger. It tells you demand may be more durable than the average asset. Relative strength does not guarantee future returns, but it helps identify candidates for a watch list. The point is not to buy everything that is green. The point is to notice what is resilient. Then research the narrative, the mechanics, the liquidity, the catalysts, and the risk. Markets rarely recover all at once. Money rotates. One area explodes, then another one narrative catches. Then liquidity moves into the next. Especially in crypto, the rotations can happen fast, and retail liquidity is not the same as it was in 2021. That means the next cycle may be harder. Retail investors are more informed. Liquidity may be more fragmented. There may be fewer easy 100 times opportunities in the largest obvious assets. Selling may be harder than buying. Attention may rotate faster, so the investor needs a system. There are market conditions where almost everything works. In a true bull market, speculation spreads, and even weaker assets can move. But there are also choppy periods where trading aggressively is a good way to lose money. In those periods, the best move is often to research, build watch lists, take small positions, and wait for the trend to align. The source uses a fishing analogy. There are times when the bite is hot, you can cast almost anywhere and get a strike. There are other times when the water is pressured. Conditions are poor, and you are mostly hoping markets work similarly. The best traders make the most money when conditions are right, not because they force trades every day. This is a major principle. Most of the year can be chop. The best opportunities may appear during only a small part of the year. If you try to force returns during bad conditions, you may lose the capital and emotional clarity needed when good conditions arrive. This is why patience is not passive. Patience is preparation. Now, another unusual edge mentioned in the source is retail attention itself. When retail investors are not watching, when views are low, when nobody cares, when people are bored, when markets feel unfun, that can be when future opportunity is forming. Retail often comes in at the worst time, after prices have already moved, and the story feels easy. So low attention can be a contrarian signal, not by itself, never by itself, but as one factor among several. If strong narratives are forming, development is accelerating, prices holding up, liquidity may return, and retail interest is still low, that combination can be meaningful. A single signal is fragile, a confluence is stronger. This is how conviction is built. Now let us discuss the specific assets in the source framework. The first is Bitcoin. The thesis is that Bitcoin remains the core crypto exposure. Above $70,000, the thesis is intact. The $60,000 to $70,000 zone is viewed as an attractive buying zone. If Bitcoin fell toward $50,000 again, that would be considered a major opportunity for someone with high conviction and experience. This must be translated into principle. Create levels before emotion arrives. If an asset you want to own falls to a predetermined zone, you do not have to guess. You act according to your plan. If it breaks invalidation levels or the thesis changes, you manage risk. This reduces emotional decision. Making Bitcoin can be a small portion of a diversified portfolio or a larger speculative position depending on the investor, but it should not be sized so large that volatility controls the investor's life. Bitcoin can move violently, it can fall hard, it can rise fast, it can dominate attention. A person who cannot handle that should size it smaller. The second asset is hype, connected to hyperliquid. The thesis is that hyperliquid is becoming one of the strongest revenue-generating ecosystems in crypto. It has deep liquidity, significant annualized fees, large TVL, large perpetual trading volume, and a value accrual mechanism where a major portion of revenue is routed into buybacks. The narrative is not just crypto speculation. It is that hyperliquid may become a broader on-chain financial venue, with upgrades that allow permissionless perpetual markets and future prediction market functionality. The platform is moving beyond simple crypto pairs. It is beginning to support exposure to oil, gold, silver indexes, equities, and other markets on-chain. That matters because the addressable market expands. If hyperliquid becomes infrastructure for 24/7 global trading, not only crypto trading, the upside narrative becomes much larger. The key is revenue and usage. A crypto protocol with real fees, real volume, real users, and real buybacks is different from a purely narrative token with no cash flow or activity. On-chain transparency allows investors to observe parts of the business in real time. But there are risks. Validator decentralization is a major structural concern. If the network is too centralized, credible neutrality can be questioned, regulation can also matter, competition can rise, revenue can fall if trading volume declines. Token valuations can become excessive. Crypto infrastructure is never risk-free. The source sees a possible move to $100 or $150 if conditions align. But price targets are not the core lesson. The core lesson is that hype has a combination of revenue, buybacks, product expansion, user activity, liquidity, and narrative that may create asymmetric upside if crypto markets strengthen. That is the thesis. The third asset is PER, a leveraged equity style play connected to hyperliquid. PER is described as Hyperliquid Strategies Incorporated, trading on the Nasdaq through a reverse merger. It holds a large number of hype tokens in its treasury, has deployable capital, an equity line of credit for further accumulation, and a share repurchase program. The thesis is that it is structurally different from many previous digital asset treasury companies because it holds an asset with operating income, like dynamics through the underlying ecosystem, and has unrealized gains instead of only speculative treasury exposure. This is a second-order play. Instead of holding the token directly, an investor holds an equity wrapper tied to a treasury of the token and a management strategy. That can create upside if the market begins valuing digital asset treasury companies again, especially when risk on conditions return, but it also introduces different risks. Net asset value premium or discount matters, corporate governance matters, dilution matters, execution matters, liquidity matters. The stock may not track the token perfectly. If it trades around net asset value with no major discount, the upside must come from future market enthusiasm, additional accumulation, treasury strategy, or re-rating. This is more complex than simply buying the token. The investor must understand what they actually own. The fourth asset is MicroStrategy. The thesis is simple. MicroStrategy is an equity wrapper for Bitcoin with leverage. Like characteristics, if Bitcoin rises strongly, MicroStrategy can outperform because the company holds an enormous amount of Bitcoin and continues trying to acquire more. This has already happened in prior cycles. MicroStrategy can move much more than Bitcoin in both directions. That is the key. It is a leveraged expression of a Bitcoin thesis, not a normal operating company in the traditional sense. If Bitcoin rises sharply, Mississippi TR can benefit. If Bitcoin falls, or if the market discounts its structure, it can fall sharply. So the investor must ask whether they want Bitcoin exposure or leveraged Bitcoin exposure. Those are not the same. The asset can be powerful, but the risk is also higher. The fifth asset is PENGU, described as a meme coin allocation. This is the speculative edge of the framework. Every crypto cycle tends to have at least one high-cap meme coin that captures retail imagination and attention. Dogecoin, Shiba Inu, and Dogwafat are examples from prior cycles. The thesis is that PENGU sits at the intersection of liquidity, branding, product market fit, Web2 reach. And consumer crypto narrative. This is not a cash flow investment. It is a narrative and attention trade. That means the risk is extremely high. Meme coins can move violently, they can dilute attention, they can be overtaken by newer memes, they can collapse when liquidity leaves, they are driven by culture, community, momentum, and speculation. A rational investor treats this as a small, high-risk sleeve, not a core holding. The sixth asset is BMR, tied to an Ethereum treasury or leverage, style thesis with a recognizable public-facing figure in Tom Lee. The idea is that Ethereum remains relevant, and a treasury-style company with strong funding, narrative media presence, and exposure can move sharply when market conditions improve. Again, the principle is wrapper dynamics. Crypto assets can be held directly, or investors can use equity wrappers, treasury companies, or leveraged vehicles that amplify exposure. These can generate large gains when liquidity returns. But they also carry structure risk, management risk, dilution risk, premium to NAV risk, and sentiment risk. The asset may go crazy when markets return, but that does not mean it belongs in an oversized position without research. Now, when all of these are combined, the Source's game plan becomes clear. Maintain core Bitcoin exposure. Use MicroStrategy for leveraged Bitcoin equity exposure if desired. Keep Ethereum and Solana relevant as major crypto ecosystems. Use treasury companies like BMR or similar vehicles as leveraged expressions when conditions turn. Accumulate HYPE as a high-conviction altcoin tied to real volume and revenue. Watch PER as a structural traditional finance play tied to HYPE. Use PENGU as a possible meme allocation or trade when retail returns. This is a crypto risk on framework. It is not a conservative retirement portfolio. It is a high-upside strategy for someone who understands volatility, narratives, liquidity, and timing. That distinction matters. A person with no emergency fund, credit card debt, and low risk tolerance should not hear this and blindly chase every asset. A person with speculative capital, research ability, and experience may decide to allocate to some of these themes. Context matters. Now, the deeper lesson is not the list of assets. The deeper lesson is how to think about asymmetric opportunity. Look for narratives before the crowd. Look for real development. Look for where liquidity will go. Look for where attention will return fastest when the market stabilizes. Look for relative strength during fear. Look for on-chain or financial data that confirms usage. Look for catalysts. Look for assets not fully priced. Look for a clear invalidation, then size according to risk. This process matters more than any ticker because tickers change. The framework compounds. Now, selling is the hardest part. The source makes this point, and it is extremely important. Buying early into a narrative is difficult, but selling during euphoria can be even harder. When a position is up massively, the mind begins inventing reasons to hold forever. The crowd becomes excited. Price targets rise. Social media becomes euphoric. Every dip is called an opportunity. People who were once afraid become arrogant. This is where many investors give back life-changing gains. If you do not plan how to sell, the market will decide for you. A good system defines profit taking in advance, maybe sell a portion when the position doubles, maybe recover initial capital, maybe sell in tranches, maybe use technical levels, maybe sell when retail attention becomes extreme, maybe sell when valuation disconnects from usage, maybe sell when the narrative becomes fully mainstream. The exact method depends on the asset and investor, but the principle is clear. Buying is only half the game. Selling is the other half. And in speculative markets, selling may be the more important half. Now let us return to the higher time frame. The source believes that over 25 and 10 years, markets are likely to be higher than today. That view is based on the long-term nature of markets, the technological advancement from AI and robotics, and the tendency of productive assets to rise over time. I would state it more carefully. There is a strong long-term case that productive assets tied to major technological development will be worth more over time. But the path will be volatile. There may be pullbacks. There may be crashes. There may be years of frustration, but sitting out entirely because you are waiting for the perfect entry can be a major mistake. If you agree with the high time frame thesis, you should have exposure now. Not reckless exposure, not all in exposure, but exposure. Then if prices fall, you buy more according to a plan. If prices rise, you still participate. The system is built around the understanding that time in the market and disciplined accumulation matter. The person who does nothing because they want a perfect 20% correction may never get the correction, or they may get it and be too afraid to buy, or they may wait for 30%, then 40%. Then the market recovers without them, waiting for perfection, often becomes a way to avoid decision. Making a system prevents that. What makes the current opportunity feel like a last chance at generational wealth? The phrase is emotionally strong, and we should not treat it literally as if no opportunity will ever appear again. There will always be opportunities. Markets always create new cycles. But the source S point is that we may be entering a rare convergence. AI is accelerating, robotics are developing, crypto infrastructure is maturing, Bitcoin institutional adoption is increasing, on-chain finance is expanding beyond pure crypto, prediction markets are growing, retail attention is still low, macroeconomic uncertainty is keeping many people sidelined. Large capital pools are preparing for risk on conditions. That combination can create a window. Windows do not stay open forever. When the narrative becomes obvious, the best asymmetry is gone. When the crowd returns, prices may already be higher. When everyone feels safe, the opportunity may be less attractive. That is why the preparation phase matters. You build watch lists when others are bored. You research when others are distracted. You decide levels before volatility. You identify catalysts before they are priced. You preserve cash so you can act. You accumulate slowly so you are not sidelined. This is not frenzy, it is preparation. Now, a serious investor must also stay grounded. The end of the source turns toward the importance of being rooted in something deeper than the market. In Ray Dalio terms, I would translate that into principles. Markets can make people reactive, crypto can make people euphoric or terrified, wealth can distort judgment, losses can create stress, public attention can create ego, information overload can create anxiety. Without grounding, investors make poor decisions. They chase because they want validation. They sell because they want relief. They overtrade because they want control. They compare because they want identity. They abandon systems because emotion becomes too loud. A grounded person is less reactive. They know what they believe. They know what they can risk. They know what would invalidate the thesis. They know how much cash they need. They know how much exposure is enough. They know that money is important but not ultimate. That last part matters. Money can solve many practical problems. It can create security, access, and optionality. But it does not solve the need for meaning, discipline, relationships, values, or self-control. A person who becomes wealthy without principles can still make destructive decisions. So the goal is not only to get rich, the goal is to build wealth without losing clarity. That is why systems matter. A system tells you how to act when you are afraid. A system tells you how to act when you are excited. A system tells you how to act when the market is choppy. A system tells you how to act when the trend is on. A system tells you how to act when you are wrong. A system tells you how to act when you are right. Without a system, success can be as dangerous as failure. Now let's summarize the entire machine. Markets have recovered sharply because worst-case geopolitical fears have eased. Earnings remain strong, AI optimism remains powerful, and investors are willing to buy risk again. But the rally is not a clean resolution. Oil remains high. Iran risk remains unresolved, inflation can reaccelerate. The Fed may not be able to cut. Another correction is possible. Therefore, the rational positioning is not to be all in or all out. It is to dollar cost average into high conviction assets while keeping cash reserves for a deeper dip. The 5 variables to watch are war, oil, inflation and rate cuts, corporate earnings, and AI optimism. Information overload must be reduced by focusing only on what changes those variables. The asymmetric opportunity framework is to look for narratives before the crowd, liquidity before it fully arrives, attention before it becomes obvious, relative strength during fear, and catalysts not yet priced. In crypto, the source S high conviction watch list includes Bitcoin, Hype, MicroStrategy, PENGU, and BMR, each representing a different kind of exposure and risk. Bitcoin is the core. MicroStrategy is leveraged. Bitcoin equity exposure. Hype is the high-conviction altcoin tied to real volume, fees, buybacks, and broader on-chain finance. Is the traditional market treasury wrapper around the hype thesis. PENGU is the high-risk meme allocation. BMR is the Ethereum-related treasury, style play. Each can rise sharply if risk on liquidity returns. Each can also fall sharply if the thesis fails or market conditions remain choppy. So the investor must build conviction, size positions carefully, and know how to sell. Now, I want to close with the practical principle: if the future is shaped by AI, robotics, crypto infrastructure, institutional Bitcoin adoption, on-chain financial markets, and a new productivity wave, then being only a consumer may be dangerous. The people who own the systems may benefit far more than the people who merely use them. But ownership without discipline is gambling. Discipline without ownership may miss the wealth transfer. So the answer is to own intelligently, build the core average in, keep cash, study the narratives, watch the 5 needle movers, look for relative strength, do not chase every green candle, do not sleep through the boring phase, do not let information overload paralyze you, do not confuse a relief rally with full resolution, do not confuse macro risk with a reason to do nothing, do not confuse conviction with reckless concentration, do not confuse price targets with risk management, do not forget that selling matters, and do not let the market become the thing that controls your peace. This may be one of the most important windows of the next decade. Maybe it becomes a true generational wealth opportunity. Maybe it becomes a choppy, difficult market that rewards only the most disciplined investors. Maybe it does both. The future will not be clean, but the principles are clean. Prepare before the crowd, follow liquidity, respect macro risk, own the assets tied to the new system, keep enough cash to survive volatility, act according to a plan. Stay grounded. That is how you give yourself the chance to be on the right side of the trade.